by now, maybe we're very close to $10,000 an ounce to go back to what historically was the portion of the currency supply the U.S. gold covers. But the U.S. Gold, the gold that is supposed to be held in trust for all of the U.S. citizens, is not going to be used to back private bank credit. Banks, they have some rules that they have to live within, and the Federal Reserve can tighten up those rules or loosen up those rules. But there are rules that govern that. But the U.S. has never guaranteed the bank credit that they create, and that's most of the dollars that exist.
Back in the early 70s, when gold was climbing out of the $35 trap, anyone who predicted $400 was ridiculed. Yet the metal didn't stop there. It ran to $873. What looked impossible quickly became history. MikeMaloney says the same dynamic is unfolding today, and this bull market still has a long way to run. The comparisons to the 1970s are everywhere, but Maloney argues that we're still in the early stages. Even if you slice the charts differently, the 70s delivered bigger moves than what we've seen so far. The difference now is the backdrop. Global debt is off the charts, growth is fragile, and currencies are eroding faster than most realize. Despite that, gold hasn't yet seen its full monetary demand surge. That gap matters. It means the real fireworks are still ahead. Maloney believes gold can at least double from here, maybe far more. Just like in the 70s, outlandish price targets will be dismissed until they aren't. He also draws a sharp distinction between how emotions manifest in gold versus stocks. Equities usually peak with smooth, rounded tops, only to collapse in a sharp crash. Gold's psychology is inverted. Rallies spike, fueled by sudden waves of fear, then retreat before the next surge. Flip a gold chart upside down, and it mirrors a stock bubble. Gold's bull markets don't end quietly. They accelerate in bursts, driven by fear, disbelief, and eventually, panic buying. If Maloney's right, we're nowhere close to that final stage. For now, the market is still grinding higher, setting the stage for the real mania still to come. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
One of the things I see, at first glance, you're saying, okay, this 2020's bull market is only 76 all-time highs. So basically, compared to 209 of the 70s, we're just getting started. However, I do want to point out that they split today's bull market into two sets of all-time highs, where they have grouped the 70s bull market into just one set. So you'd have to take the 106, add 76 and 106 together, but still, it doesn't matter. The global economy is in a lot more trouble than it was back in the bull markets of the 70s. And gold being a monetary asset, it's really when monetary demand hits. And we haven't had it yet. We've got fear of missing out, which is completely different. That's greed-driven, not fear-driven. And we've got some people getting prepared because they see something dangerous in the road ahead, but not that many. So as a percentage of the population, not that many. Not enough people own gold yet for this to be anywhere near being over with. I think we absolutely have more than a double in gold. I think that, if I had said that $10,000 was possible when I wrote my first book back in 2007 and 8, it came out in 2008, but it was written in 2005, 6, and 7. And if I had said that $10,000 was possible, everybody would have called me absolutely crazy. But one of the things that I've put in both books is that, at the beginning, back in the early 70s, when gold was just leaving $35 an ounce, a lot of economists thought that gold was going to fall in price, not rise, because there wouldn't be any more central bank demand now that it was demonetized, basically. And anybody that predicted that $100 was possible was considered an absolute lunatic. And if you said $200 was possible or $400, it was like tie him up and put him in a rubber room because this guy is really crazy. And we ended up going to 873 intraday. So anyway, early on in bull markets, people point to the people that end up being very accurate, the ones that were actually right, and calling them crazy. And so I still think that there is a lot more room to run. If you take a chart of gold and turn it upside down, it looks more like a chart of the stock market. The stock market has these round distribution dome tops and these real sharp crashes and V bounces that are fear-driven. Gold, it's fear-driven toward the tops. And so you've got these spiky tops that it really does look like an upside down. The gold looks like an upside down stock markets chart. Stock markets look like an upside down gold chart. And it just shows that the dynamics of fear and greed are very different in these two asset classes. The problem here is that the source is World Gold Council and Incrementum AG. And I don't know, did they include ETFs in China and so on? Most likely they don't have that data because the gap between those is most likely made up by people in the East. It's investment coming from China and then the wedding season in India and so on. There's two things going on here. That plus central bank buying. That could be one of the reasons for that gap, because the ETF holdings isn't what is putting a floor underneath gold. It's definitely coming from elsewhere. And so this, at the beginning, I said that, it wasn't people. You said that more people have had interest in gold lately. Yeah, a few Westerners, but not that many. It's mostly Asia that was driving this. And I think this is the chart here that sort of shows that it's coming from somewhere else. It's not coming from the retail investor in the United States.
People ask, what would gold have to be if it backed all of M2? MikeMaloney says that line of thinking misses the point. The Fed doesn't back all bank credit. Approximately 92% of the money supply is created by commercial banks rather than the central bank. The Fed's role has always been narrower, backing currency in circulation. That's what gold was historically tied to, not the entire credit system. Run the numbers on that basis, and the picture changes. Maloney points out that if you measure gold against just the notes in circulation, you end up with a very different valuation. Using the Fed's data, specifically the H.41 release, U.S. gold reserves only line up with paper currency, not bank deposits. Do the math with those figures, and gold comes out to roughly $9,000 an ounce. At the last check, the calculation came out to around $9,044. Factor in recent changes, and you're likely closer to $10,000 today. That's the level gold would need to reach if the U.S. ever went back to a system of fully backing currency with gold. Maloney's point isn't that this will happen tomorrow, but that it provides a valuable benchmark. It demonstrates how undervalued gold remains in terms of the monetary system structure itself. Instead of chasing flashy M2 projections that don't align with how the system works, he narrows the focus to what the Fed covers. By that standard, the gap between current prices and a fully backed currency is massive, and that gap underscores the long-term case for much higher gold. Let's get back to the interview.
It would be interesting to plot this growth against inflation, except you'd have to pick some sort of mean between the way the government used to measure inflation and the way they measure it today, because we've shown lately the difference between the shadow government statistics, alternate CPI, which is the original way that the U.S. calculated inflation, and then the way that they keep on fiddling with it. Every few years they change their methodology of calculating inflation just to massage the numbers and make them look a little bit better to everybody. But it would be interesting to plot these, because this is where the inflation comes from, ultimately. There are short-term changes in velocity and some other things that cause inflation and lack of inflation, but ultimately, this is where it comes from. and you said if it grew equally with the population. First of all, M0 incorporates a few different aggregates of the currency supply. What gold backs currently in the monetary system and historically is only the currency in circulation. It backs the Federal Reserve notes. So trying to calculate what it would have to be if it was to cover M2 is absolutely pointless. It's ridiculous because the Federal Reserve does not guarantee all of the bank credit that is created. It's not going to ever cover bank credit. So for anybody to run these calculations of, well, what would it take if gold covered the currency supply? I believe it's about 92% is created by the banks and not the Federal Reserve. And so you have to eliminate that. So those blue bars are basically a pointless exercise. It's never going to happen. It won't. Right now, almost all, how much did we calculate? It was like 99.7% of all America's gold was pledged to the Federal Reserve. And so they have basically a lien on America's gold. And those gold certificates, which could be revalued under this new system that Scott Bessent was talking about, and something like this, I think this might be in our future. It's going to be a giant shock to the global monetary system if it happens. And it's only really going to happen if there's a major crisis. But I see a major crisis coming. Historically, we had treasury notes, 100% backed by gold. So if you had a note, that was the IOU. If you had a dollar bill or a $20 bill, that was the IOU from the treasury. And it said there have been deposited in the Treasury of the United States $20 in gold coin payable to the bearer upon demand, right on the note. And so that was the IOU. And a gold standard is self-funding. A gold mining company digs up a bunch of gold, sells it to the Treasury, and the Treasury buys it just by creating the IOUs for it. So they print the currency, and then the gold that they just bought backs the IOU. So it's a self-funding process. It's nothing that has to be taken out of taxes or anything else. But the 40% is the ratio that fell apart during the Great Depression. When the Federal Reserve was established, we went from a 100% gold backing of the currency, the IOUs, to IOUs that were only 40% backed, meaning 60% of the IOUs were fraudulent, that this was a lie. And that's what caused it to fall apart, is because they were lying. So if they pick a 40% reserve ratio, this is the reason I've always said, gold standards suck. Gold is great, but gold standards suck. The lie is what fell apart. And then they didn't establish a by law reserve ratio for the Bretton Woods system. And they just kept on creating currency, and it fell to about 8%. But basically, you and I already did this calculation in one of our videos from April or May, but it was $9,044 to cover 100% of the currency in circulation, not M0. By now, maybe we're very close to $10,000 an ounce to go back to what historically was the portion of the currency supply that the U.S. gold covers. But the U.S. gold, the gold that is supposed to be held in trust for all of the U.S. citizens, is not going to be used to back private bank credit. Banks, they have some rules that they have to live within. And the Federal Reserve can tighten up those rules or loosen up those rules, but there are rules that govern that. Free market factors plus how much headroom does the government want to be able to do deficit spending? Because this really puts a constraint on everything. How much currency you're going to create. They're talking about gold-backed bonds, and they used to have gold-backed bonds before everything fell up. Before Roosevelt made private ownership of gold illegal, they had to abrogate, it's called, the gold clause in all of the U.S. Treasury bonds that said they were redeemable in lawful money, which included gold coin.
Yeah, no more lawful money, not in this country.
Right. Right. So for anybody that wants proof of this, just go to the Federal Reserve's website or just do an internet search for Federal Reserve H.4.1 release and scroll to the bottom, and you will see that the only place on the Federal Reserve's balance sheet that the U.S. gold is being used monetarily is to back currency in circulation. That's the last item on the H.4.1 release. And if you take the number of ounces that we've got divided by the currency in circulation, you need $9,044. At least that's what it was when we made a video about it recently, to back the currency in circulation. And that is what they did historically.
Gold ticked higher on Tuesday, but it's still stuck beneath the levels that matter most to traders. The market is basically in wait-and-see mode ahead of this week's Federal Reserve updates. The lift came as the US dollar index slipped 0.1%, giving gold a slight tailwind by making it cheaper for buyers outside the dollar zone. At the same time, bond yields are holding steady or lower, and expectations for a softer Fed stance continue to lean dovish. That mix sets up a cautiously bullish short-term picture, but only if gold can punch through the resistance lines capping its moves. Until then, it's more drift than breakout. History shows that what once looked unthinkable can quickly become the new baseline, and today's setup has many of the same ingredients that fueled past surges. With debt swelling, currencies weakening, and buyers circling for a breakout, the stage feels set for another dramatic chapter in precious metals. Is the current hesitation simply the calm before a rush that redefines how high gold can go in this cycle? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.